What's up, YouTube? Will back with another video. Just got off work about 30 minutes ago. Ended up clocking in 42 hours of the course of 5 days. I am exhausted. I am ready to go to bed, but I'm committed to this. I'm gonna stick with it. Didn't really know what I was gonna do for my video today, so I went back to my video I made last night, and I'm going to use this one of the ideas I had, which is go over this research list that I've created. It's just a list of companies that I want to look over their fundamentals and technicals to see if it's worth looking into, putting my own money into. Just to say that none of this is financial advice. This is my own personal thoughts and opinions and analysis. All right. If you want more videos like this, let me know. I don't know if this is something people would actually be interested in the future. I mean, only a few people watch these videos anyway. Um, all right. I want to start with this is my third take on the intro. So I was going to start with Sweet Green Ink, just making sure my portfolio doesn't show up. Yes, it doesn't. Okay, perfect. I typically go to summary first. I'm having a little issues pulling the summary up. Here we go. Yep. Fast food restaurant, healthy foods. So it is a consumer cyclical in the restaurant industry. Sweet Green restaurants. What restaurants do they operate? Wikipedia, always the perfect place to go first. Uh, Sweet Green is a fast casual restaurant. I've never been. Does not offer full table service but advertise high quality food. And fast food restaurant with fewer frozen and processed ingredients. So the first thing that I got from reading this is that it's trying to stay away from fast food. But it says it also doesn't do any offer full table service, but it's trying to be healthier. And as we've seen in the last 5 to 10 years, um, younger people are trying to be a lot more healthier and stay away from McDonald's, and other fast foods. So anything else I can get from this? Not really. Um, I've never been to Sweet Green. Another thing I do want to look at is pull up macro trends in a second. I use that in the other video. Now financials. I normally use the phone when I go through this, but I wanted to record it. So that's why it's here. That's not what I want statistics. Okay, first thing I look at is PE, and we're not getting one. That is concerning. So the next thing I would go is to macro trends. It's not pulling up. Sweet. Typing is struggling. Revenue. Revenue looks good. We're seeing growth, constant linear growth. Net income is negative. It is improving. Now, next thing is operating income. It is improving and it's about to be positive. They are selling more shares. That's not something you like to see. Very little not long-term debt. I know I switched over to macro trends. It's just a little easier to see and visualize everything. Um, all right. All right. Free cash flow is the perfect. This company is not making any money. It's not retaining any money. It is losing money. It is bleeding money. So next question is why? So it's bleeding money out of its ears. This income statements, gross profit 28 million, correct? No, that's a billion. And I've never seen a Sweet Green. Okay. It's all going to SG&A. Red flag, massive red flag. As we talked about in the last video, that's a lot of his administrative expenses. It's spending more money on just keeping the business open, and why do I always have a hard time explaining SG&A? It's basically there's a great thing on the other day. I think it was this picture. the costs of running the business that are not related to the production of the business's goods. So just keeping the restaurant open costs more than the money that they're getting, not even the profit they get from it. So we're gonna go ahead and stop following this one. We're gonna go ahead and move on to the next company. That was a pretty quick one in the grand scheme of things. Can I get back to my research without fucking everything up? That is the real question. Bam, 26 symbols. Hopefully we can go through these a little faster. Uh, let's go and do an airline. We're gonna do Delta. So I personally do not like investing in any airlines because they have to spend a lot of money to keep business flowing. If something goes wrong with any sort of business, they have to bleed money profusely to keep that business afloat. We saw that during 2020 when something massive and unpredictable, a black swan event happens like that, they barely stay in business. So, as we saw, if you exclude 2020 and 2021, we have a linear growth in revenue. In most recent quarter, we had 6%, 7, 5. We've seen slowing growth. Um, Net income kind of all over the place. This is something you would really expect from a airline. I'm going to take this shares outstanding. So we're seeing in the most recent years, they're actually selling shares back to the public. To raise money is typically what companies typically sell shares back to the public to raise money. So that is not something you want to see right now. You want to see if a company really has confidence in its business and they think their stock price is undervalued, they're going to be buying back stock. And in this case, for Delta, they're not, which is a little concerning because we pull up TradingView right now. Pull up Delta. We're going to pull up a weekly charts. Um, Actually, in the grand scheme of things, they're kind of moderately priced right now. If we go to the daily, it's under the 200 moving average, which is it would be a good time to buy if you're looking to. Uh, But let's keep going with the fundamentals. I want to go to the other ratios. Current ratio. This is what I mean with airlines. I think Delta has one of the best CEOs out of all of the airlines. Um, God, I listened to one of his calls. I completely forgot his name. They have a great management team, and I'm from Atlanta, so I mean, I always run Delta. Here we go. Ooh, Ed. This guy. He looks like the just random guy, but he's been doing a great job. And I listened to one of his conference calls during COVID. Um, really held things down the best that he could. Now, this is very interesting. 50% ROE is outstanding. Why is it like that? Why is equity so low? So we're on the balance sheet right now, switch to quarterly so I can get a more detailed view of what's going on. So I always love looking at retained earnings, basically seeing how much money Delta has sitting around. It's a little more detailed than cash on hand, in my opinion. So right now I also love seeing retained earnings increase steadily. So after we saw they used all their retained earnings in 2020, 2022, in 2021, obviously for COVID related reasons, I'm assuming we're seeing an incre where they're going back on track to increase retained earnings. Um, but back to it, liabilities are less than assets. So like when we were looking at Starbucks the other last night, that this is a better fi balance sheet than we would look at for Starbucks, which is very odd because the amount of money Delta has to use to buy more planes, advertise to get people to get on these planes. They are a much more competitive environment than you would see from Starbucks. Anyways, um, we want to see shareholder equity increasing steadily. I'm assuming we might hit a plateau at 15, so we're getting to about that top level. Um, Any the only red flag that I really see is that it is an airline, and I don't know if I would ever want to invest in an airline. But like right here, we're seeing a PE of 5, 6, which is just absurd. Is that completely correct? We're going to Delta. PE of 5. And another thing I always like to look at is analysts typically give a growth estimate. I like the next 5 years per annum. So this is actually very attractive on Delta's end. This is actually something I'm going to move into not research, but a buying list where we're going to go look at a more detailed view in probably another video. Or I'll maybe do 2 videos today so I don't have to do one tomorrow. Not really sure yet. I have a big buying list, yeah. Research. We have to go. I'm going to start moving a little quicker. Dexcom, right? Yes. Let's read what Dexcom does again. Medical service, medical devices in the healthcare. Glucose monitoring. So this one's going to be a lot more out there for me. It's not something I'm completely, I know a lot about. But this is insane growth over 15 years. And we're still seeing 20% growth. That is absurd. Income growth is a little more inconsistent. But that's fine if you're getting revenue growth of 20% year over year consistently. Um, we're seeing ooh, that's something I don't like. Like I said earlier, that I like seeing companies buy back their stock. I like profit margins a lot higher, very good profit margins. PE is pretty high, 48. For cash flow is also something I love to look at to see if, let's give a detailed view of what free cash flow is, because I don't feel like I can explain it the best. Yeah, basically, I like calling it retained earnings, but free cash flow is a better way to say it, I guess. Other ratios, debt to equity, a little high, ROE, if it would work. I am human, 29%. So I kind of like this. The last thing I do want to look at is to see, like I said earlier, what are analysts expecting this to grow year over year since we're valuing it as a growth stock. So we're saying it's 16.2% per annum. Um, I think based on that, we shouldn't be seeing a PE above 40. And we're seeing a PE above 40. Um, yeah, like we're seeing right now, we're seeing 46 and 44 when we're not seeing, let's look at a bit of, we're not seeing, wow, what the hell? 30%. Okay, this one might get a second look. This one might get a second look. Okay, this one might get a second look. This one might get a second look. All right, next. Um, I just want research. Cardinal Health, medical, another medical company. Okay, I'm gonna act like I got that. This is a lot. If I do all of these, this is gonna take a long time. But I'm gonna keep going. How many do I have on this list? I have 24 more. Good Lord. Why do I do this to myself? Cardinal Health revenue first. Green. We're seeing, I love seeing this little up. Yep, we love that. EBITDA is a hot mess. What the hell happened in September of 2019? Income, not good. Shares outstanding, amazing. We love to see a downward, um, what do you say, negative linear right here. Um, we're seeing them profusely buy back stock over time. We love to see that. Um, margins, we want to see 60% on growth. What? These are awful margins. These are atrociously bad. That's why we're seeing them have struggled so much to make money. Nope, I'm good. I'm good on Cardinal Health. Those margins are not for me. Next, we're going to be on AstraZeneca. I don't do not a lot of healthcare in my list today. Biotech, a lot of drugs. Okay. Um, all right. I don't know any of those drugs off the top of my head. Um, so for drug manufacturers, you typically or at least the way I look at it, you invest or buy stock into the company when you have faith in a drug to do well. Because these drugs do not last long. You don't want to hold a drug manufacturer company for forever. These patents only last about 10 years or so. That's why you're seeing what is it, Squibb? Bristol Myers and Squibb. Yeah, they had a bunch of their patents run out and they had to get new management. My personal favorite is Merck right now. I'm not looking to add another drug manufacturer to my portfolio, nor I guess I'm going to give it a quick just skim. Wow, that's a lot of growth. Okay. But like right here, you see that the what is this? What happened from 2010 to 2019? I mean, I could definitely take some guesses. We had a world health epidemic, and now you all of a sudden want to have all this growth. Um, yeah, I'm not a fan. Margins, great margins actually. We're seeing above 60%. We're actually getting 80% gross margins. Current ratio, not great. Debt equity, amazing. I hate it when it does that. ROE is a little off. It's because the equity had a giant jump. Weird. Um, Last thing I'm going to look at is the balance sheet quarterly and then go look at retained. No. All right, next. I'm not a fan. Not a fan. H&E equipment. Ooh, we got an industrial renting and leasing company for equipment rental, sales of rental equipment, repair and maintenance. Okay. Okay, okay. I already hold Caterpillar, so this is probably I would not be replacing my Caterpillar with this company, but I mean it is worth a look. We're got a 10 PE multiple right now. I first want to look at the growth estimates. 25% for a rental? 2 quarters missed. Okay, very bizarre. Um, Growth is cyclical. That's why we're seeing it look like a roller coaster. It goes in and out of seasonality, depending on the market. Net income looks a little odd. Um, EBITDA looks fantastic. Odd again. We're seeing no share repurchases of any kind. We're going back to the balance sheet to check retained earnings like we've done on every company. That looks beautiful. Sorry if I'm going fast. We got a lot of companies to go through. Current ratio is below 1 again. Not the best. ROE looks great. What the heck? Dividend is 2%. They don't miss a payment. See, this company's worth a second look. It is worth a second look. And I hate to say that because I do love Caterpillar, but this one is a lot more attractive than Caterpillar right now. Um, all right, next, we're gonna put this in the buying list. All right, Lockheed Martin, no, I'm gonna stay that for a little bit. Stellantis, that's a good one. This is probably gonna be a big fat nope. They make Dodge, they make, I think they do Alfa Romeo too. They do, uh, fuck, they do a lot of cars. They bought a lot of different car companies over the years. Jeep, Chrysler, Dodge. I know they have I think they do Alfa Romeo as well. I'm not completely sure. They do Fiat. They have all these car brands. The problem with owning cars, um, operating expenses are a little high. They typically hold a lot of debt. So I think if I go to these assets and liability sections and hit long-term debt, we're gonna, ooh, I mean, we're growing a lot of debt right now. We're seeing Stellantis has only been around for since 2015. Okay, okay. We're not seeing any growth in any sort of any kind. What is this hot? This is garbage. This is garbage. Car companies are just tend to be like that all the time. Um, they're hit or miss. I was in Tesla for a very long time. I took my fat bag, and I dipped the hell out of there. That's what I did. Texas Instruments. If you haven't noticed, I do typically do my fundamental analysis before I do any technical analysis. Um, my fundamental analysis for the research, since I put so many on my research list, is very brief, very quick. And then I add it to my buying list, and that's where would do more of a deep dive. I make a DCF, I'll go through the company call, I go look at their margins at a more closer look. Why are those margins like that, et cetera, et cetera. Um, but like for this, when I'm just having a quick glance at the company itself, I'm not going to do a deep dive. As we see, Texas Instruments, they're a semiconductor company. They, I, if you want to put a product to a face, I believe they used to make those calculators we had in school, those graphing calculators. I'm pretty sure those are them. The thing I do not like about Texas Instruments is they're very cyclical. We look at the EBITDA, we looked at the revenue. Revenue looks like a roller coaster. EBITDA looks like a roller coaster. It's not, you really want a company, if you're going to hold for more than medium term, you want it to look like a positive linear company. Exponential growth does not last. You cannot keep growing like that. You want something linear. But I do help manage several other portfolios, and I did recommend this, and we did end up buying Texas Instruments back in, let me look, uh, TXN. This would have been, I think about the 160 to 150 level is my guess. Somewhere in the 160s, 140s to 160s, it would be around this area right here we bought. We did reach a 52-week high, or just an all-time high, at 210 back in July. I mean, we had an earnings beat, slight earnings beat, so I didn't really look into it when it came out. But we're back at 200. I mean, long term, I think Texas Instrument is fine. PE of goodness 31, and we're expected to grow negatively. Okay. See, this is where my personal, I guess, rules as the companies I hold, the stocks I hold in my portfolio, I don't really like cyclicality. I like linear growth. I don't want to be seeing, oh, we grow consistently for 5 years. No, not even like 3 years, 2 years maybe. And then we go down for 2 years because for take a Dell, take an Intel, we're seeing a decrease in computer sales. We're seeing a decrease in GPU sales, keyboard, mouse sales because people only hold a monitor and a computer for 5 years, and then we're going to see a super cycle where we go back to growth. I don't like holding that. We never know when those cycles are going to happen. We can guess, we can anticipate, but there's no get act firm knowing. So for Texas Instruments, I would not going to buy it ever in my personal portfolio just due to the extreme cyclicality of the name. Um, Eli Lilly is next. This one is a big, massive name. Either way, I don't think I'm going to do a deep dive into this one. I already know a lot about it. If you don't know about it and you want me to look at it, just and you're actually watching this, let me know in the comments and I'll actually do a deep dive into it. But for now, it's going back in the watch list. Why? Okay, we just had a giant earnings beat, I think on Thursday where if you did want to get any sort of chance at buying it, you would have had bought it at 750. You're not, that's the best price you're going to get. And like, look at this earnings surprise, a 42% earnings surprise on earnings, not even revenue. That's absurd. This thing is going up here, or we're just going to sit here and consolidate until the 200-day moving average can catch up. Um, yeah, that's my thoughts on Eli Lilly. They have one of the best drugs in the world right now with Novo Nordisk with those GOP-1s. If you don't know what it is, look it up. But for me, I had my opportunity to buy it, and I'm going to have to wait. We're seeing analysts are expecting this company to grow 76% per annum. That is ridiculous. I don't even think that's possible. I mean, it could be. That could be. So we're expecting it to nearly hit or hit around $3 trillion for a drug company in 20. Wow. I just don't know if that's possible, man. We're already sitting at a 71%. Good Lord. I think it's a little overvalued for what it's at right now. Just 'cause people are going on an earning craze. But for now, yeah, I already put in my watch list. I'm gonna wait for a better uh price. If you want me to do a video on it and actually give a price target, I will. But for now, we're gonna move on to Robinhood. This dumpster fire of a stock. It was been a meme stock for a long time. Wow, I didn't know they actually did this. Year to date, we're looking at 56%, 48 6 months, 5 years. We look like this crap. Um, let's take a look at it at Robinhood in here. It is a app on your phone where you get to trade stocks, cryptos, and I think you might be able to do commodities. I'm not sure. Um, we're seeing some back to revenue growth. That's good. EBITDA was positive for the first time in March. This doesn't have the most updated quarter, so I don't know. I can pull it up in here first. Is it Y? Okay, there we go. Earnings second quarter. we had actually positive earnings. So it's making money. It's making money. We're not buying stock. Margins are extremely high gross. So why, if it has such high gross margin, why are we not making a lot? And of course, we have another company where SG&A expenses are extraordinarily high. We have a product where you have extremely high gross margin. When you're a broker, there's not a lot of expenses to actually run the business. But instead, well, am I being an idiot again with SG&A expenses? Am I I think I am. This picture. I'm gonna have to Okay, so this is what um employees expenses. This is too high. This is way too high. And it's been too high for years. This needs to improve. Um, so I want to go look at operating expenses, operating margin. We want to see this improve. And we are seeing it improve slowly. And is that because operating expenses are shrinking? Are they expanding? We're seeing operating expand. Uh, we need a quarter. I need a quarterly look. So operating expenses is kind of what I'm looking at. We're seeing them decrease a little bit. SG&A expenses are decreasing a little, well, slightly, not in the prettiest way. But like, what is going on in the end of the year or the beginning of the year where we have these giant jump in SG&A expenses? I don't know. I just don't like holding brokers. IKBR or Interactive Brokers is another company where I don't know why. I just feel like I would never invest in this. However, all I feel like newbie investors or like people just want to get into the market, the first thing you're going to go look at is going to be a Robinhood. You're not going to go look at a Vanguard, a Fidelity, a Schwab. You're going to go get a Robinhood. So that's where Robinhood really gets its business from, and they do a very good job of that at the end of the day. And they have a very um, neat and clean UI interface. Um, which is why a lot of people are drawn to it. However, if people had any sort of memory or attention span, they would know that Robinhood has a very bad reputation due to the scam. I wouldn't call it a scam, but I would have to really educate myself further on the topic. But I know back in 2019 or 2018, I mean, you can probably just look at the stock price and get it. Yeah, this, whatever you want to call this. 2021. Late 2021, they had a little fiasco where they weren't allowing people to into their accounts to sell or have any sort of transactions whatsoever. And I think institutional investors or other investors were allowed to. Um, I think no matter what, that kind of steers me away from the company if I know that's what you're about. Um, Hopefully they had a change in management. Ooh, this is a tough one. I'm like torn whether to even keep looking at it. We're seeing assets increase, liabilities increase as well. ROE, obviously it's going to be negative. It might eventually get a little better. They carry like no debt. Current ratio is great. Ah, why do I like it? Why do I like it? If they can just get their SG&A and actually not um, run the business cheaper, they need to cut costs is what they need to do. If they had a big cut, if they cut costs a little better, we would be good and dandy. What is this candle? the earnings candle is bizarre. It's really throwing me off. Like we have this support level, it looks like at 16-ish, mid 16, and then this just breaks it. Doesn't hit any sort of level that I can really, yeah, like what is this candle? Very bizarre chart. I mean, I know what I'm looking at clear just based on this long I'll have to paint it out just so it makes sense instead of just me just talking. Let's do this. This is going to be a long, this is what in the trading and breakout world you would call a long base box. You obviously could have been in here trading options and scalping it. However, on a more longer swing time frame, this is what you would call a base box. You had a breakout and a gap up at earnings back in, when was this? Earlier this year, where we had a breakout and it ran and ran and ran until it hit its peak at 24. This is a very clean breakout. Um, I wish I would have been there to play this because good Lord. Um, it would have been really good to pick up stock like here, just looking at a technical level. But if we're looking technical now, I mean, it breaks 25. The next support is 33, and then after that, this thing, hell, its biggest was 85. So like, there's room to run definitely in Robinhood. It's probably going to do another a consolidation is my guess. Um, Probably come back to this 25 level, maybe this 21 level. That would be my guess. As we hit the 21, we come back, we form another box, then we break up, meet. Okay, let me paint it instead of just trying to talk and um. So this is what I would guess. We go up here, we break down to the what the 200 moving average is going to be, and then we break back up, and then we break back down, and then we get that. If I had to guess what this chart's going to do, it's going to be some sloppy BS like that. Um, all right, so it would come up, reach this resistance level right here. I'm going to just paint it out as a horizontal line just so you can see. You kind of meet this, you may break it. Either way, you're going to hit the what is that, the 50 first, which is going to be also right next to that support. So we're probably going to see a jump or rejection, come back to the 200-day moving average. Then we're going to bump off of that. Hell, if we break down and we go back in a consolidation, whatever. And then we come back up, we meet this relative 52-week high, and then we break through that and we run again. See, as an option, I would probably play it. Long-term equity, I think that has already passed. Because then we're looking at, do I believe in the business? The business is a little shaky. I don't like what management did in the early 2020. What was that, 2020, 2021? Something like that, where they did that with the pause. Ooh, rough one. Rough one. Really make up your mind on this one. Do you believe in that app? Because at the end of the day, it is an app. Can they? Why are SG&A expenses so high to run the damn app when it's just an app? You're just a brokerage. You don't need a million bajillion employees, all this cost to run this. If you just had cost cutting, this would be amazing. This company would be a lot better than what it is. Um, yeah, I think I'm going to actually take a second look at this, and I don't know why I feel like that. How long are we at right now? Um, 40 minutes. I think we're gonna cap it at an hour. I probably should have just streamed this. I am gonna put my Twitch in the description and in the outro. I'll mention it one more time. Um, For future reference, I'll probably be doing this as a stream instead of a recording. I think that would probably be a better idea. This is probably gonna be a one-time thing where I make a video this long. Lockheed Martin. Um, defense company. They make missiles, they make planes, they make helicopters, they make trucks, they make guns, they make anything to do with war. Um, and we just saw them have one of their best quarters ever. I think it was their best quarter financially ever. Um, I have held this company in the past. I actually sold it for a gain after it broke out. Taking a second look at it just because it kind of ticks all the boxes for me. Um, I think, does it have a high gross margin? Yeah, I think that was the only problem I had with it is I don't like its margins. Um, I wish it would sell its goods at a higher margin than it does. Um, that's my grip with the company. Its operating expenses, I think, if I remember correctly, are very good. A company that has no, yeah, what? All right, that's got to be wrong. You always have SG&A expenses. I wish the only thing with this is I wish you would sell your arms, your helicopters, your planes at a higher margin. I know you already go in and put millions, bajillions into each plane, airplane, whatever. I just wish the company would increase their margins. I want to see margin expansion. I don't want to see margin contractions, and that's we're kind of just floating around maybe 14% margin. I wish it was a little better. I think the company is greatly run. I love the CEO. He hires the most veterans out of any other company, if I'm correct. Might need to be fact checked on that. Um, yeah, we're gonna just skip Lockheed Martin. I do have a portfolio that I manage for somebody else that has Lockheed Martin as a long-term holding. As a long-term holding, I think it's great. I would probably be taking profits right now in Lockheed Martin. Um, yeah, because we just had this massive, whatever you, whatever the hell you want to call this. Get rid of this indicator. It's cluttering up my screen. We're seeing this massive gap up. Um, broke all-time high by lots, and we're still moving higher. Um, I think the last thing I want to touch on for Lockheed Martin is at a 20 multiple right now, meaning a 20 PE multiple. If you don't know what that is, you probably should not be watching my videos. And it's only expected to grow 4% per year. So that means, grand scheme of thing, you're really just buying into the safety of the name and that the world is at war right now. So that is why I personally do not hold it in my own portfolio, but I would always have it in a watch list because I think it's a great company. 3M, big hot name as well. Got into a big fiasco with earbuds and veterans. They gave some veterans hearing loss or something, and they had a big settlement. Um, yeah, let's look at it on TradingView. Big gap up after earnings. We had a big surprise. Not really. Probably something was said on the call that people liked. It's still buyable. You really could still buy it if you want. It's in the bullish camp now, where it's probably gonna be running and hitting some other resistance levels. At this point, it's got room to run at the 200 level. It is what you would call a dividend aristocrat, where it pays 2%. I wish that was a little better, actually. Um, it's one of those companies that just continues to grow. It's had a problem in the last 2 years or so with creating new products, It needs to be creating new products, and its revenue growth has stalled, as you can see. It also had a medical device company that I think it just spun off, which is a little odd. So this is at one-time charge, or it looks like it's two-time charge, um, from that settlement that it had. Either way, say we went back to PE from before the charge, we're looking at an EPS of 9.6. 9 points. I'm doing this on my phone. I don't have a face cam or anything like that. So if you do the price it is right now, which is 127.05 divided by 9.68. Wow. What? That can't be right. You're looking at a P of 13. So if you disregard the one-time charge, but it's also expected not to grow. So it's really, so this is a company where you have to, if you would want to look into it deeper, you would have to believe in the future of the company because right now, prospects for it are very low. It's in the dumps. It's more would be a more of a turnaround play. I don't have the highest respect for its management, if I remember correctly. Um, yeah, that's 3M. I was actually looking at it down here, but for some reason, I just can't get myself to hop on board. It may be about the settlement. It may be about the fact that people are expecting it to continue to have problems innovating new products. There's a lot to it. It's really not a simple thing, and I don't have full faith in the company as a whole. Like hell, we look back at these earnings in May of 2018, we're seeing earnings disappoints very frequently. I mean, we've seen some better ones more recently. And I wish that if I'm buying it for a stable dividend, you're not getting that anymore. I mean, it is stable, but I wish the yield was a little better for a name like 3M. So I'm gonna just put that in the watch list. CVX. I mean, everyone's been to a damn Chevron at this point. I'm gonna go first to, are we expecting this company to grow a lot? The answer is no. So you're buying it for dividend and oil exposure. 4%, 4.43% dividend is incredible. Um, Personally, I would probably recommend this for one of my other portfolios that I manage. Ooh, ooh, yes. I'm definitely going to be recommending this. This would be a stock I would recommend for anybody who does not have oil exposure in their portfolio. I already do. We're seeing also, now that I'm looking at this, we're seeing a very beautiful consolidation right here. I mean, let me go ahead and let me put this random box first. What about a monthly? I bet a monthly would be a little more clean. Yeah, we're seeing kind of a consolidation. Um, I'm gonna turn on an indicator that I used in one of my older videos. It's called Squeeze Pro. Yep, where it indicates consolidation in short squeezes. So we're seeing very bullish indicators. Um, that is a very, and look at this touch. Touch the 200 week moving average and bounced. Um, we're under the 200-day moving average, which is another key level where people tend to buy. If you're under the 200 moving average, it's typically a good buying point for most stocks that are healthy balance sheets and good futures and dividends, et cetera, et cetera. Um, so this would definitely be a name. I've already looked through its financials. I know them pretty well. so I'm not going to look back over them. It is a cyclical name and tied to oil, so it'd be an oil exposure play. Um, I'm putting in the buying camp. Let's run through these in the next 10 minutes. Bristol Myers, we talked about this earlier. Yada, yada, yada. PE of dog water. PMY. Is it PMY or is that? Yes, I got that right. Revenue increased. We've seen it stall. It is a drug manufacturer. If you want to look at Bristol Myers for yourself, I would. Ugh, goodness, I want to look at the dividend before I. Very consistent dividend. Oh my goodness. Why do I like this? Oh my god. Let me stop doing this to myself. What is this? What happened? Why did margins just go to kablooey? Why did margins just, why did it lose money in this March quarter? It has nothing. What? Those don't add up. 16. We had operating income. Most recent quarter, maybe? Yeah, it looks like we had some sort of one-off charge that I don't know about. I've not heard anything in the news about a one-off charge. Cash flow from investment. Acquisition. Acquired something. In all cash? I did not know that. So we're looking at acquisitions made recently. Here we go. Maritai diversifies into oncology. Another radiopharmaceuticals. That's another acquisition into oncology. So we've seen one, two, three acquisitions. All right, historically, acquisitions are actually not good for investors. They are a little exciting, you could say, but I think great friend of mine, he's very smart. I think he said the number is 70% of the value or something. I would have to, I'll get back to you guys with it. But you don't really, you shouldn't love acquisitions as an investor. It's a little exciting to see them go into oncology. However, I am a Merck holder and I love my Merck. Um, this is, and they don't have any drugs or anything that I'm really excited about. Be something I would have to really follow up on. Um, Something I am going to recommend to some portfolios that I manage though, so I'm going to keep that there. Uh, 54 minutes in, looking at GoDaddy. I don't even remember what the frick this does. Application e-commerce platform. Application commerce core platform. No, no, no. I don't want to go to GoDaddy. Is this like, what does this do again? Domains? Yeah, no. I'm gonna go ahead and say I don't want anything to do with this. I'm gonna go look at revenue growth though, because probably this company does not make money. I figured this is what it would look like. About a bit of. Okay, what the heck? I'm gonna have to look at this again. I am going to have to look at this again. Oh my god, how many do I have? 12 left. in 5 minutes. That's hilarious. Texas Roadhouse, ew. PE of 30. Yeah, I don't know why. What the heck? Texas Roadhouse revenue looks amazing. Net income looks amazing. Shares outstanding. Why is this good? Why is this good? Bad, bad, bad. Bad margins. So I'm assuming in the restaurant industry you see very poor margins. That is something I'm seeing consistently, and I work in the restaurant industry, so I guess I should know that. Um, Mainly gross margins. So as Texas Roadhouse do not, their gross margins I wish were a little better. Um, 16% is not something I love, and yeah, I'm good on Texas Roadhouse. Next. Okay, why did I say no to Texas Roadhouse? The dividend, if you didn't look at the end, they cut dividends and changed dividends. That's always a red flag for me. The gross margin was not very good. I wish they were a little better, but I understand why they are where they are. They are in the restaurant industry, and they are trying to keep it reasonable for a nice family outing. Um, Coursera, Dell, American Airlines, RTX, Viking, Lineage, all of which I'm going to continue in a stream. I'm going to start streaming right now, and I'm going to continue till I finish this. If you would like to join the stream, I'll leave it in the description. Um, I think I need to reset up the channel a little bit beforehand, but it will be in the description. Let me know if this is something you want me to do in the future. It's a little interesting for me to get my thoughts out for the world to see, I guess. Any other closing thoughts, statements? Again, this is just my thoughts, opinions, analysis. Um, Anything I would recommend for people to look at? Uh, I'm going to put a book in the description as well. It's a very useful research if you're wondering where I get the numbers, I get the thoughts, because I mean, I guess to a normal person who doesn't have a lot of experience in the finance field, a lot of the stuff that I've been doing on my channel for the last few videos may be a little overwhelming. I understand that. I'm going to do another video right after this where I kind of go into it. I need to make a greeting for my channel where I really tell people what I'm doing because some of these videos would definitely be a little overwhelming. Oh, an hour-long video into a bunch of companies. For a normal person, you're probably not going to look at that and be interested. So, yeah. Hope y'all enjoyed. If you made it this far, I really appreciate you. That means the world to me that you can watch this. Uh, if you could leave a like, that would mean a lot to me. Subscribe if you really enjoyed this. Give me some feedback about what's something you would want me to do. I'm thinking about doing real life content eventually once I get comfortable, once I get a routine down. I do work out. I try to work out every day during the week, Monday through Friday. But I do work out at the Y, so that might be a little difficult. Um, yeah, thank you for getting here, and I will see y'all in the next video. Peace out.